Well, I'm joined today with Rick Palumbi, our Director of Research. And as you can see, Rick's actually coming in via satellite from his home office. So welcome, Rick.
Great to be here, Kev.
And Rick oversees our international equity strategy here at CWB McLean Partners. And so, Rick, we're going to start with international investing. And, as international investors, we can't own US technology companies or, the US big tech stocks. So, where do we look internationally to outperform?
Yeah, it's been quite interesting to us that most of the investing world is focused, on the FANG stocks and how they will benefit and have taken advantage of what has been happening due to the COVID disruption. However, there are other global opportunities, not in the technology space, believe it or not, that have also flourished. For example, European luxury goods. Luxury goods have often been referred to as Europe's FANG, given their quality and growth characteristics. The chart on the screen nicely illustrates that point. What most investors have underappreciated is the resilience of the business models of these luxury companies. This has allowed these companies to outperform US tech, not only on the upside, but also in the latest tech correction in September as well. Having owned luxury names in the portfolio through multiple cycles, we weren't surprised. In fact, the best in luxury class houses are having a much better crisis than feared in 2020, with sales down only 20% versus expectations of minus 35. The demand snapback in China has been very strong, and e-commerce growth has been accelerating globally.
Okay. Well, excellent, Rick. So I like that. European luxury goods equals US FANG.
Exactly.
Okay. I know further on this theme, I know you attended a virtual investment conference with the team in September and had the opportunity to speak with the CFO of Prada, one of our luxury goods position. And maybe you can share with our viewers some of the insights you gleaned from that conversation.
Yeah, it was interesting. The opportunity was great for us to speak with her, and her comments really echo the data that we're seeing, and also reinforce the thesis on Prada. A couple of things really stood out for us, though. So Prada mentioned in their quarterly call that their sales improvement in July that they said was improving was still there, and sequentially, August was better than July, and September was shaping up to be better than August. That was pretty impressive for us because they still have 30 stores that are closed. And the second point she made was that COVID has changed the business plan time frame, but noted that the quality of sales in Prada due to retail as opposed to more retail as opposed to more wholesale has been better through this crisis. And in addition, additional investments would not be needed to support higher sales. That was sort of a big aha moment for us because part of our thesis is that, Prada will have margin expansion in the future, and that should be a catalyst for the stock. So to sum up, companies we own like Louis Vuitton, Remy Cointreau, Richemont, and Prada are prime examples of how brand equity and brand power can translate into higher stock prices.
Yeah. Okay. No, thanks, Rick. That's excellent. And if I'm a client, I'm thinking, in addition to owning some US technology stocks, the European luxury goods would be a great diversification component to include in my portfolio.
Absolutely.
Yeah. Super,
Absolutely.
Rick. Thanks very
Thank you.
much.
Thanks, Kev.
Well, I'm joined by Imran Usmani. Imran works on our international equity team. Welcome, Imran.
Thank you, Kevin.
Now, with this pandemic economy, seems to be a consensus view that a lot of these older economy sectors and older economy stocks are basically dying and going to the wayside, and everybody's focused on, US large cap tech. Are there some old economy sectors that are surviving?
I'm glad you asked that question, Kevin. And I can give you an example of a sector that's not only surviving, but also surprisingly thrived during the pandemic. Shipping is a sector that you wouldn't expect to do well during a downturn. However, ironically, it's been able to do just that. And unlike multiple tech stocks that you speak of that are being driven by investor crowding and optimism and expectations about the future, the performance in the shipping sector is being driven by what we believe are possible, fundamental, long-term structural changes.
Wow, okay. And so how are we investing in this theme currently?
So Kevin, we've spoken about Maersk in previous episodes, and for our viewers that haven't followed our last few episodes, Maersk is a large Danish integrated shipping company. It's the largest container shipping company in the world, and that gives it a cost advantage. It also boasts a very healthy balance sheet. So we're playing the sector through Maersk, which meets our process and investment philosophy.
So Imran, that sounds very interesting with regard to Maersk. Now, what industry fundamentals are driving this outperformance?
So Kevin, because it's a much more consolidated industry now than in the past, it is able to respond much faster to demand conditions. In the short term, the industry is able to park ships or increase the amount of idle capacity or decrease it depending on whether there's reduced or higher demand. Over the long term though, the industry has been ordering fewer ships over the last few years. And you can actually see that on the next chart on your screen. You can see that new build orders are sitting at historical lows versus their long-term average. And they're much lower than the levels we saw before Hanjin went bankrupt in 2016. Now, all of this has been really positive for shipping rates, which you see on your screen right now. And this is a very important driver of profitability for the sector and this company.
So Imran, that's a great update on Maersk and how the industry is doing rather well in this pandemic economy. The key question though for our clients, investors, is a lot of this good news already priced into the current share price, and how are we managing the weight in our portfolio currently?
So Kevin, in our opinion, Maersk can generate double-digit returns on capital over the medium term compared to single-digit returns on capital that the industry and company has generated over much of its recent history. And that's just being driven by the healthy rate environment and the lower capex expenditures, as we saw that the new build orders are sitting at historical lows. Now, it's also important to note that we don't need the rates to be as high as you saw in the previous figure for the company to be able to generate those levels of returns.
Right.
Now, on the next chart, we show you the price to book multiple history of Maersk. We feel that if the company can generate double-digit returns on capital, it can achieve a price-to-book multiple of about 1.5 times compared to the 1 times price-to-book multiple that it's trading at right now.
And Imran, price-to-book value ratio, just for our viewers, is a valuation metric, kind of like price to earnings. So, currently Maersk is about 1 times price-to-book, and we think it could be as high as 1.5 to 2 times. So there's still lots of upside in this position.
Yeah, so Kevin, we started our weight in Maersk at a below average weight compared to relative to other holdings in the pool. Mm-hmm. And then over time, we've opportunistically added to the position, including in the recent downturn, and we brought it to an above average weight. And then most recently, we've taken off some weight to reflect changes in the risk reward profile.
Okay, excellent. So Imran, thank you very much. It's a great example of old economy sectors and old economy stocks still generating a good return on capital, and most importantly, a good return for our clients. Thank you very much.
Excellent. Thank you very much, Kevin.